Welcome everybody. This is George Veter from Veter Financial Group, and I'm going to have a chat with you here on June 9th. Okay, what we've experienced this year has been a lesson in uncertainty. And to put it in context, we had the Liberation Day that was declared April 2nd, and that's when the market went into free fall for a period of time. We had the big days of losses. And then it was April 9th that President Trump put a freeze on the tariff enactments for 90 days. And then he made exemptions for the phone makers and the automobile parts and electronics. And that was a really big signal to the market that President Trump was aware of his public approval rating and its relationship to the market, I think. And so the market started rebounding, and then we've had a furious rebound. So now the Dow sits at, let's see, when I looked at it before this video blog, it was at 42,859. It might have changed a little bit, in the last couple of hours, but we've had a big rebound. The high was 45,073. So we're not that far from the market high that was set in February. Now, in between where we are now and where we were in February, a lot's happened, not just with the tariff, but of course there's spatting and the different players in Washington, and then Wall Street's interpretation of things. Here's what I want you to kind of frame in your minds is the general scenario. This was a massive disruption and continues to be a disruption that Wall Street is just dealing with now. And it's the third of three big disruptions in the last 5-year time period. Very similar to 2020, we had the pandemic. Now, if you'll remember, in March, the market plummeted down over 20% on the S&P. And that was based on the uncertainty of the moment when we had the lockdown and how the government was having us respond to the pandemic of COVID-19. Then the market took back off in April because there were parts of the economy that were actually benefiting from the pandemic scenario. And the worst case scenario that we reacted to in our minds in the beginning of the year looked like it wasn't going to play out. So the market started pricing in a recovery from the pandemic, and we ended up positive for the year. We had a very solid year. If you had a diversified portfolio that would be considered moderate, like a third in bonds and a third in value and a third in growth and a little international in there, you were somewhere around 10-11% in that ballpark for 2020, where the first quarter it seemed like it was the end of the world, like the wheels were coming off the bus. Then we had a really positive 2021. Then 2022 comes along, and in June we have a 9.1 CPI inflation reading that freaks everybody out and creates the second big uncertainty on Wall Street in that 5-year period ending now. The Fed aggressively started reacting, and the worst case scenario was priced into the stock market over the summer. We were looking at, most analysts believed that it was a certainty we were going to have a recession that never showed up. Bottom line is the market plummeted in the third quarter and then started coming back in the fall. And the worst case scenario didn't happen, so the market breathed back. And then we had a very positive fourth quarter of 2022, great 2023, very solid 2024. Now we have the third big uncertainty moment, which is the tariffs and the uncertainty over what's going to transpire with trade deals and trade talks around the world. So I just want you to know that I don't have the exact answer. The only thing certain is changing. I don't know what's going to happen tomorrow, but I know that capitalism works and that we find a workaround around all of these moments of uncertainty. And I've never seen in my lifetime, 32 years in the business, this worst case scenario play out, because people don't sit in the ashes and die. Businesses react and they overcome and they innovate and they figure out a way, and we move forward and we get to new highs and the market gets to new levels of possibility. And I think this is no different than all the times we've seen in the past, especially in the past five years. We've had 3 of these. Okay, a couple of things today. It's Monday. On Friday, we had our inflation data and our labor data, and it came out better than expected. Inflation is cooling more than most people thought it would, at a higher rate than most people thought it would, or at a faster rate. So now the question is the Fed going to lower, and when? And I don't know. I would say the average consensus that I could find this morning would be September for the first lowering of interest rates for this year. We'll see how that plays out, but we know they're coming. We just don't know when and how many and how far that's going to take us. But that will be a positive event for the market. So let's talk about the things that will help us go higher. These clouds of uncertainty that will be lifted at some point, hopefully over the summer. We'll get clarification on interest rate cuts at some point. We will get a budget bill passed at some point. We will get a new tax law made permanent at some point, or tax bill. And we will get some trade deals done. Now, any of those things that the market's holding their breath for that present clouds in the economic future right now, as those clouds dissipate one by one, will give the market excuse to go higher. That's honestly what my crystal ball, in parentheses, is telling me. Okay. Now, the third quarter, I want to talk about that. In the third quarter, historically, the average return since 1945 of the market, the S&P or the Dow or any of the stock market indexes since World War II. So you can see the average rates of return and the seasonality of the market. We expect the third quarter to be a tougher quarter. Now, who knows? We had the big wahoo in April, so that might have taken some of the third quarter normal kind of difficulty out of the market. I don't know. And any of these things that I talked about that are clouds on the economic forefront, they could dissipate and they could cause us to go higher at any time. But usually we expect not a lot of good stuff to happen in the third quarter. In fact, September historically is our weakest quarter on the calendar, and then August is our second weakest quarter. Average returns on the S&P since 1945. The good news is then we get to the best time of year for stocks, which is the fall. Starting in October, but we have November, December, and January that are our best rolling quarters historically. And that's been my case since I've been in the business, or my experience rather, is that that's when we do the best financially, and we have the consumerism of the holidays, we have the earnings that come in October, and then the year-end things of people finalizing their pension contributions and all of that help the market do well in that period of time. So I'm telling people that I think, like all times of, or all moments of uncertainty, there's opportunity here. Emotionally, we tend to overreact. It's just the way our neurological system works. And so whenever there's a moment of uncertainty, we've overreacted on the downside, pricing in the worst case scenario. There's an opportunity to buy great companies at cheaper prices than we would have last winter or last fall. So that being said, if you have extra money, or if you have money being transferred into our fund during the summer, we're going to recommend a dollar cost average program where you invest 50% of it in the model that makes sense for you and your goals. And then we're going to keep the rest in money market, the other 50%, and go July, August, September, October. So a dollar cost average for 4 months to get you fully invested by the middle of October. So seasonally, you have the best chance to make gains and actually make money with any volatility that we might have in the summer. Making money meaning getting you more investments bought at cheaper prices as we keep pricing in through the volatility. Now, I will tell you this. I've never been more optimistic about the long-term growth track of the United States. I know that the emphasis, and it won't be in a straight line, is to get our deficit spending under control and get a sustainable fiscal path, and to grow the economy, or to unleash the animal spirit in American innovation and in entrepreneurship and capitalism. That's all the emphasis for the administration right now, and I'm not saying that I endorse everything in the way it's done. I'm not being political at all. But the idea of making government a little less expensive and free enterprise a little easier to grow just makes me excited for the future. And I think we get these clouds that I mentioned of uncertainty dissipated over the next 3 months. And then I think you'll be very happy with investment returns and the way that the world works economically for the next 3 years. I'm super grateful for your patience in this. We've been very communicative, and many of you have called with concern during this volatile second quarter. And I want you to know that I feel what you feel. I'm in the middle of it, right? I have hundreds and hundreds of clients that I empathize with and understand the feeling of of uncertainty and fear. So be communicative with us. We do these things to try to touch everybody as often as we can. We do our quarterly meetings, but when you have a moment where it gets scary and you listen to something that kind of disorients you, call us. That's our job. The more communication, the better. And we'll get through this moment of uncertainty like all the others, and we'll move higher and help you to get to your goals. And I'm grateful that you trust us, and we'll continue to be worthy of that trust. Talk to you next time.